Welcome back to the Finance Shark. In this video, we are going to tell you about 6 mistakes real estate investors make. This video is going to be amazing, so make sure you stick to the end. If you've heard about real estate investing, you may be interested in trying it out for yourself, but it's not always easy. Some people are able to get into the market and get results quickly. Others tend to have a harder time with it. We've all made mistakes. It's just a part of living, trying, and learning. And it will happen to you as part of your investment career eventually, if it hasn't already. Wouldn't it be nice, though, if you could learn from the mistakes of others with decades more experience? That's precisely what we're going to do with this real estate investing video, and with the help of real estate investors who have been in the game for over 40 years. Our master real estate investors identified 6 mistakes real estate investors make that, if avoided, can lead to better investment results. Before starting the video, be sure to smash the like button and subscribe to never miss out on any of our videos. So quickly, let's get into it. Number 6. Hiring a bad property manager. Having a great property manager can make your life fantastic. You don't have to worry about anything. They will run the business and you will make money. Hiring a bad property manager will make your life miserable. You will always be worried about the property, and you won't make as much as you should. A bad property manager is like having a horrible quarterback on a football team. If your quarterback is horrible, you aren't going to win any games. A property manager is the quarterback of your team. They make sure your team, your business, is running well, and they work with your tenants. They make sure your income is coming in, and they make sure expenses aren't falsified. So, how do real estate investors identify a bad property manager? Well, there are several steps real estate investors can take. First, real estate investors should talk to the current real estate investor tenants of the manager they are considering hiring. For other tips, take a look at our video on top questions to ask when interviewing a property manager. Number 5. Not planning for all expenses. If the investment is going to be the first property you have ever purchased, it's easy to forget the additional upfront expenses. The deposit isn't the only thing you need to save for. You must have a buffer to cover all of the other expenses that come along with a property purchase. Just some of these upfront expenses include insurances, building inspection fees, lender's mortgage insurance, if required, taxes, major repairs, and legal fees. Number 4. Not crunching the numbers. Your property will not be profitable if you're not renting it at the right rate. This means that you should be carefully looking at the rental rates in an area before you make your purchase. If you think that you'll be able to rent out the property for a combined $2,500, assuming you have multiple units in the building, then you'll want to purchase a home with a mortgage payment that's less than $2,000, producing an appropriate cash return on your investment. Otherwise, you might not be getting enough money to cover your mortgage payment, repairs, maintenance, and property taxes, much less turn a profit. Number 3. Not having a great plan and goals. If you want to be successful in anything, you need to have goals. Whether they're long-term or short-term, you need to know where you're going. When you're brand new, it gets to be quite exciting. You always want to be going after the next deal and the next, and you find yourself going for deals that don't fit your comfort zone or have a high risk level. The important thing is to have a goal that makes sure each project you undertake fits the plan. Not only that, but your goals serve as a type of motivation for when things start to get hard. They give you something to keep pushing forward on. Not to mention, they keep you right on course. Think about it in terms of what you want in the short term and the long term, and then figure out how you can create a strategy that fits. Number 2. Not saving for future repairs and maintenance. You need to give yourself a cushion for repairs and maintenance. If your property rents for $1,000 a month, 10% or $100 should be saved towards future repairs. It is still your money, but you need to save it in case you have repairs. You don't want to go into credit card debt to fix or replace a roof. Plan for these things. When you have one property, save enough for 1.5 times the rent and let it sit there. As you accumulate more properties, you can have more or less money in the repair fund, depending on your risk tolerance. See our video on emergency funds for rental properties. You may not need thousands and thousands of dollars because there are only so many furnaces that will go out, but save enough so you will be prepared when things happen. Number 1. Lack of research. Not doing the research before buying a property can be detrimental and could result in low returns, high levels of mortgage stress, and maybe even a failed investment venture. It's important not to jump the gun and make a big purchase without ticking the research-related boxes. Doing the legwork early will streamline the purchasing decisions and increase the likelihood of a successful investment. You need to look at things like the location's property value trends, average rental yields, vacancy rates, employment rates, local infrastructure, the time a property spends on the market, and overall demographics. From a financial standpoint, you need to determine how a property purchase will affect your cash flow. This was all for today. Hope you liked the video. Do not forget to subscribe to our YouTube channel. Stay safe, and we will be back soon with another video.